All right, welcome. Today we're diving into a topic that, let's be honest, often trips people up in their accounting studies: pension accounting under IAS 19. If you're gearing up for professional exams, you absolutely have to get this right. So, let's pull back the curtain and make this whole thing a lot simpler.
Everything about pension accounting really comes down to this one simple question. When a company promises its employees a pension, what are they really promising? Is it as simple as just putting some money aside each month, or is it something much, much bigger, like a massive long-term debt that's going to hang around for decades? If you can get your head around this distinction, you're already halfway there.
So, to answer that big question, we have to understand that there isn't just one kind of pension promise. IAS 19 basically splits the world of pensions into two. And believe me, knowing the difference between these two isn't just helpful, it is absolutely critical for your exams.
Okay, so on one side you have your defined contribution plans, or DC for short. With these, the company's promise is pretty straightforward. They say, we will contribute a defined amount, maybe 5% of your salary, into a pot for you. They make that payment, and boom, their legal obligation is done. But on the other side, you've got the defined benefit, or DB plan. Now this is a whole different ballgame. Here, the company is promising a defined outcome, a specific benefit you'll get in retirement, usually based on things like your final salary. It's a much bigger promise.
So, here's where it gets really interesting. The absolute crucial point is, who carries the risk? In a DC plan, if those investments don't do well, that's on you, the employee. Your final pension pot is just smaller. Tough luck. But in a DB plan, the company has promised you a certain amount no matter what. So if the investments tank, it's the company that's on the hook to find the extra cash. They carry all the investment risk. And that right there is why DB accounting is so incredibly complex.
So because the company's holding all that risk in a DB plan, how on earth do they account for it? Well, they're sitting on this massive, uncertain, long-term liability. And the cost they recognize each year isn't just one simple number. Oh no, it's actually made up of three very distinct pieces that you have to understand. For your exams, you absolutely have to be able to break down the total pension cost into these three components. You've got your service cost, your net interest, and then the really tricky one, the remeasurements. Think about a big constructed response question. You're going to have to navigate through multiple exhibits to find these numbers, so knowing exactly what you're looking for is a huge advantage.
And this slide lays it out perfectly. There's a fundamental split here. Some of those costs hit the profit and loss statement, the P&L, affecting the company's reported profit. But others are deliberately kept separate in what we call other comprehensive income, or OCI. You can think of OCI as this special holding area within equity, designed to capture all the volatile ups and downs that aren't really about the company's day-to-day operations. This whole idea comes straight from the IFRS conceptual framework. It's all about giving investors the most faithful and relevant information possible.
So let's look at what hits the bottom line first. In the P&L, you've got the service cost. That's pretty simple. It's the value of the pension promise your employees earned by working for you this year. Then you have net interest. Okay, just imagine that pension liability is like a giant loan. Every year that passes, you're 1 year closer to having to pay it back, so the interest on it effectively grows. That's what we call the unwinding of the discount, and it's treated just like a finance cost in the P&L. So what gets parked in that special OCI holding area? The remeasurements. This is the bucket for all the unpredictable stuff. For example, what if new data comes out showing that people are, on average, living longer than we thought? Well, that means the company's future pension payout just got bigger. That's an actuarial loss. Or what if the pension fund's investments had a terrible year? That's also a loss. We put these in OCI so that a company's reported profit for the year shows how well its actual business did, not just how turbulent the stock market was. Now, we've talked a lot about pension deficits, but what if the plan is actually doing really well? What if it's overfunded? This brings us to a very specific rule that is a classic test of your ability to apply your knowledge to a real-world scenario, the asset ceiling test.
Okay, let's just think this through for a second. Let's say your pension plan has way more assets in it than it needs to pay out its liabilities. You've got a surplus. Great. On paper, that surplus is an asset. But does that really mean a company with $1 billion surplus can just stick $1 billion asset on its balance sheet? I mean, what economic benefit are they actually going to get from that?
Well, the standard says, not so fast. The asset ceiling is basically a cap, a reality check. It says you can only recognize that pension asset up to the value of the economic benefits you can realistically get back from it, like, say, by reducing the contributions you have to make in the future. It's there to make sure assets aren't overstated, which is a fundamental principle of good, prudent accounting.
So far, we've mostly been dealing with the rules, right? The black and white stuff. But now, we're going to shift gears and move up to a higher level of thinking. We're talking about evaluation, professional judgment, and even ethics. This is where you go from being a student who knows the standard to a professional who can apply it critically. And frankly, this is where the biggest marks are in your exams. So here's the scenario. That entire pension liability, it's just a giant estimate of payments that are decades away. And to make that estimate, you need assumptions. And assumptions, well, they require judgment. So how could a management team that's under pressure to post better results use that subjectivity to their advantage? The key lever they can pull, the magic wand they can wave, is the discount rate. This is the interest rate used to bring all those future pension payments back to their present value today. And the absolutely crucial thing to get here is that this is not a fixed number. It's an estimate, chosen by management, supposedly based on the yields from high-quality corporate bonds. And this slide shows you the devastatingly simple chain of events. A manager, wanting to make that pension deficit look a bit smaller, just nudges the discount rate assumption up by a tiny fraction of a percent. But because the liability is so huge and stretches so far into the future, this has a massive impact. A higher discount rate automatically leads to a lower present value for the liability. And a lower liability, well, it almost magically makes the deficit on the balance sheet shrink.
This quote really just says it all, doesn't it? Choosing this rate isn't some minor detail you find in the notes. It's one of the most powerful tools or weapons in a company's financial reporting arsenal. As a professional, you have to approach this number with huge professional skepticism. You always have to ask yourself, is this a reasonable, supportable estimate, or is this being used to manage the numbers? And that leaves us with the ultimate question, the one you'll face not just in your exam, but throughout your career. Look, accounting is full of estimates. A little bit of optimism is allowed. But when does that optimism cross a line and become misleading reporting that could hurt investors, employees, and other stakeholders? Your job as a professional isn't just to memorize the rules of IAS 19. It's to have the ethical backbone and the courage to challenge assumptions that just don't pass the smell test. And that is the real mark of a professional.